Hello, welcome everyone. Thanks for joining today. I'm just going to give just a couple minutes for people to jump in here. Just a quick overview on myself. I am Marshall. I'm a mortgage broker in Toronto. I've been a mortgage broker for about 13 years now. So I've seen some ups and downs with the market, with rates. Over that time, I've worked with more than sort of 500 families and borrowers to help guide them through the process. I really look at myself as like an advisor, educator. My goal is to try and help my clients understand their options, understand the process, and be confident in kind of making their mortgage decisions. And so, my goal with this presentation is to try and communicate as much of that over to you guys during this process. So hopefully you guys have some takeaways from this that bring some clarity and understanding on the process and kind of where the market's at and how it works. Um, I know that if you've been waiting for your finances or the market to feel right, you're not alone. I felt this when I bought my first home, like such an overwhelming process. And so like my message is just like confidence to move forward comes from understanding your budget and what drives the real estate market, whether it's in Toronto or whatever the market is that you're looking to buy in. Um, I want to ask just off the jump, what's the one thing about buying your first home that feels the most confusing right now? If you guys can share your thoughts in the chat, would love to see what your take is on it. So I got a few, all of it that will be negative equity before move-in day. So I think that kind of speaks to like the state of the market. The three most common answers I get to this are the mortgage process feels overwhelming, pre-approvals, credit scores, income requirements. That's one. Two is just affordability fears, not knowing how much house you can really afford or what you should be buying. And then the third is like the mixed messages of the market. Should I be waiting? Should I be buying? Is the market going to crash? Is the market taking off? What's happening with interest rates? So those are kind of like the three most common questions I get. And so hopefully, you know, today I can help simplify some of that and provide some clarity for you guys. I think like the three most important things are clarity on where you guys fit into the home buying journey, where you're at, what you need to do to get there, and then the current state of the market. Confidence with numbers in terms of what you can afford and how to budget, how your budget really works, numbers to understand. And then the third is having a trusted resource. I'm here to, help you understand your options, help you understand where you're at, and hopefully moving forward, I can be someone that you can lean on for guidance when you're ready. So first, I'll touch on kind of the state of the market. Um, I think there's three pieces of information that go into affordability, home prices, interest rates, and your financial situation. The truth is that you don't have a lot of control over home prices or interest rates. You need to understand them, you need to understand how they fit in, but those shouldn't be the guiding decision makers for you when you're buying. Home prices are going to go up and go down short term over an extended period of time. On average, home prices rise about 3 to 4% annually when you spread that out over like a 20-year period. I think real estate is extremely expensive to get in and out of. Real estate agent fees, land transfer tax. So home prices would be an impact if you were buying and selling quickly, but so will those fees. And so a real estate decision should really be a 5+ year decision so that one, home prices won't be as much of an impact when you decide to sell and buy. And then two, that you're not going to be hit with a ton of fees to be buying and selling constantly. Um, Interest rates, I think this is an important to know, but not necessarily an important decision factor because particularly in Canada, although we have fixed and variable mortgages, we're all essentially on variable rate mortgages. Most fixed mortgages have a 3 or 5 year term where your rate is going to reset. And so every 3 to 5 years, you're going to be renegotiating your interest rate. And so you're going to have a lot of different interest rates over a 25 or 30-year mortgage that you end up having. You could have five, you could have 10 different interest rates. And so to buy a house based on an interest rate is a wrong move, in my opinion. You need to be comfortable with rates going up and down. And so you should be really buying to a budget where it allows for fluctuation in interest rate. You're not buying because interest rates are at 2%, because many people that did that back in 2021 are now realizing that those rates were a bit of an anomaly and are stretched on their budget. And so for me, it's the third piece, your financial situation, that is the most important. Are you in a strong employment situation, strong relationship situation? Do you know where you want to live for the next 5+ years? If the answer is yes to all of these things, then it might be a good time to start exploring. If there's anything there that's wavering, then you might want to get on a little bit stronger ground before you think about buying. So for me, in terms of understanding the mortgage approval process and the buying process, really comes down to three pillars, four stages, and two critical numbers that everyone needs to know. The first is the three pillars, and this is what lenders are looking at when they're determining what they want to lend you. The first one is your credit. There's three pieces that are the most important when it comes to your credit. It's your balances, your repayment history, and the length of time you've had stuff open. There are other factors like having your credit checked. These are less impactful. The first three make up like 70% of your credit score. So, credit score is going to be kind of like your passport to mortgage lending. If you have a credit score above 680, you meet kind of the minimums for best interest rates, minimum down payments, those kind of things. If your score falls below that, you may need to have 20% down. If your score falls below like 620, you may have to look at alternative lenders that are more comfortable with lower credit scores as a short-term solution, or look at ways to help repair your credit so you can get that on track and open up these other options. The second pillar is your down payment, and this is the money that you're contributing to the purchase. There's some different thresholds in Canada. Minimum is 5% down, and that goes up to $500,000. So, as an example, if you're buying a $400,000 home, the minimum you have to have is a $20,000 down payment. Then, once you get above 500,000, up to 1.5 million, you have to have an additional 10% down on that amount above 500,000. So if we take an example of a $700,000 home, you'd have to have 5% of 500,000, which is 25,000. And then you've got an additional 200,000 above that. You have to have 10% of that. That's another 20,000, 10% of 200. So you add those two numbers together, your 25 and your 20, you need to have a minimum of 45,000. When you do that, there's mortgage insurance required. So you're considered to be a higher risk borrower because you have less money in, less skin in the game. And so the mortgage lender is required to go to a mortgage insurance company to get insurance. You pay for that, it gets added to your mortgage balance, but that adds a set of criteria to your mortgage approval that the lender doesn't have control over. The insurance company providing the insurance sets the rules, and there's three insurance companies in Canada, and every lender in Canada has to go to them to get your mortgage approved if you've got less than 20% down. Above 20% down, It's considered a traditional mortgage. There's no insurance required. You are just getting approval from the mortgage lender. You don't have to pay for the insurance, nor do you need their approval. So that's why traditionally you've heard got to have 20% down because it avoids the insurance. The truth is there's merits to both. First and foremost, like putting less than 20% down, you have to pay the insurance. But you typically get lower interest rates when you put less than 20% down. However, you do have that upfront cost. With the insured mortgages, there are a lot of rules that have changed recently that are making them more competitive. So you can now, as a first time buyer, get a 30-year amortization on an insured mortgage where it used to be 25 last year. So that's a big change that helps make it more affordable, even when you're putting less than 20% down, where you used to have 20% down to get a 30-year mortgage. That's only available to first time buyers. If you're buying a second home, if you're buying again, that's not an option. So kind of nuance there. One of the biggest benefits historically for the 20% or more down is that you could get that 30-year amortization. So that's a big benefit. You don't have to pay the insurance. Interest rates are slightly higher, but usually that's offset by the lack of insurance. The third and probably most important pillar is cash flow, and this really determines how much you're going to be able to borrow. Cash flow is how much income you have coming in, and then what debts you have going out. So, is there car payments, student loans, credit card debt, or line of credit debt? If so, that's going to impact how much you can borrow because a mortgage is an agreement with a lender to repay over a 25 or 30-year period. And so they're looking at what do you have coming in from your job, from income that will be able to service a monthly payment to them. And that's why cash flow is what really decides what you can borrow. There are sort of standard guidelines. You can expect to borrow up to about 4.5 times your income if there aren't any debts that are restricting that. There is a buffer built in there to allow you to have some debts that go towards, or sorry, some debts that your money is going towards without impacting how much you can borrow. But if it's too large of an amount, it will dial back how much mortgage you can get. Um, Sorry, I see there's a few questions there in the chat. I will try and get to every question at the end. I'm just going to kind of work through this, so please drop them either in the Q&A or drop them in the chat, and I will try to address every question before I wrap up. So the second sort of framework that I look at is the stages of buying. And 4 stages: pre-approval, shopping for a home and offering on a home, approval, and closing. And it's really important to understand these because each of these has their own sort of requirements that you need to do. Pre-approval is massively important. It is a look at what you can qualify for, but also allows us to hold interest rates. And when we're in a current economy that we are today, that's really important because rates are shifting. And so a pre-approval is going to look at your financial situation, your income, your debts, and determine how much you can borrow, how much you qualify for, help you set a budget. So for me, I work with every client and provide them a detailed budget ahead of time so that we can start to think about not only what you qualify for, but what you should be comfortable spending on a monthly basis and where that might vary over the years, so that you can then start shopping for a property that's within that budget rather than what the bank approves you for. When you get pre-approved, we can hold an interest rate for 120 days. So you have time to go out, find, offer, and then close on a home within that 120-day period and have a guaranteed rate. So even if rates go up during that window, we've got something locked in. And so that's where a pre-approval can be pretty important. The second stage is shopping and offering on a home. This stage is going to be really important. You're going to be working with a real estate agent. to help you find the right home, the right neighborhood. Think about things you might not think about going through this the first time, like who the neighbor is or the state of the roof. All of these things are massively important if you're going to be living somewhere for 5 or more years. And the process of buying a home can be massively emotional. And so it's really important to have a partner, real estate agent, that can help guide you through that process and think about things that you might not think about the first time through. So finding a good real estate agent that you trust, that's honest, that has experience is hugely important to help guide you through that side of it. And then the offer is once you've found a home, you now need to submit an offer to the seller to buy the home. That is going to have a couple different really important pieces that I find are kind of the negotiation items. So there's your closing date, the date you want to take over the property, a deposit. So you are providing a cash certified check with your offer. Typically, that's going to be about 5% of the purchase price. So you do need to have that readily available through a line of credit or in a savings account because you have to be able to provide that within sort of 24 hours of writing an offer. It's less of a negotiation piece. It's pretty standard in most areas, but it can be something if a larger deposit is provided with the offer, maybe that looks better than someone else's, but typically not a moving piece. The next two are probably the most important, right? Pieces, your purchase price, so what you're offering to pay for the home. And then the second one is conditions. So typical conditions you might include in an offer are condition of financing. And that would normally be for 5 business days. And that allows you, once the offer's been accepted by the seller, we know the price, we know the closing date, to go back to our mortgage lenders or lender that we have identified as the one we want to go with and get you fully approved. And that means getting you approved for buying the property at that price point. It also means the lender is now going to look at the property that you've bought. Are they comfortable lending on it? Do they agree with the price that you paid for it versus what the market says the property's worth right now? And that's done through a home inspect, or sorry, through an appraisal. The next condition might be a home inspection where you have an independent third party walk through the property and look at all the different features, the roof, the furnace, the walls, the basement, and give you commentary on the state of the home and what might need to be fixed. So that's the second. We've got condition of financing, condition of home inspection. And then the third one is most relevant for condos, and that's a condition of status review. Status is the financial statements for the condo. And there you want a lawyer to look at that to see, are the finances in a good place? Are there any adjustments coming? Adjustments being like, oh, the windows are falling out of this condo and they're all going to have to be replaced. And so we're adding $10,000 to every unit. You want to know that before you buy. And that's all going to be laid out in the status because it has all the meeting notes, all of the financials, all of the legal decisions as it relates to the condo. And so you want to make sure you're reviewing that before. The next stage is your approval. I've kind of touched on this already, but that's when we go to the lender for a full approval on the property. We decide on an interest rate, an amortization, a mortgage amount, and we apply for that. Then we have a window to the next stage, which is your closing, which is when you actually get the keys. And one of the most important parts of my job, I feel, is that window from approval to closing. As a mortgage broker, my job is to look out for your best interests. And during that window from approval to closing, interest rates can change. If we've got you approved, let's say at 4.5%, and interest rates drop before your closing, if you go direct to your bank, they're not going to call you and say, hey, our interest rates are lower. We'd love to offer you something lower. Working with a broker, every bank, every lender we work with is emailing us every day about what their rates are. So the moment we see a rate drop, we get our clients' rate holds or approvals updated to a new lower rate. And so that window from approval to closing can be a really great opportunity to save some money because when we get you approved, we hold the rate at the highest it will be, and we try to get you the best rate between then and closing. The last piece I will cover here is the two numbers that I feel actually matter most when you're buying. On the right here, I've got um, a sample budget that I use with every client. So this is a Google spreadsheet that I create for every client that we use as kind of like a workstation when you're shopping, when we're going through the pre-approval process, so you really understand the numbers. And the two important numbers for me are money to buy and money to own. And that's represented in the closing costs and the household budget. So you'll see here, these are kind of the mortgage terms and property tax info, your purchase. The money to close is going to be made up of your down payment, legal fees, so a lawyer to represent you during the closing process, land transfer tax, which might be municipal and provincial if you're in Toronto, or maybe just provincial if you're buying outside of Toronto. Um, Tax on mortgage insurance if you're putting less than 20% down, and then other legal adjustments. Um, like title insurance and wire transfers, all of those things. This is a total amount of money you're going to need to be able to provide to the lawyer on closing day. You will have a deposit that you give with your offer. If you're doing that, here I've got zero, but if you're doing that, that will reduce how much is owing on closing day. You are credited for the deposit that goes towards your purchase, towards your down payment. The second number is money to own. And again, this is massively important number because you want to know what it's going to cost you on a monthly basis. So here you might be looking at monthly mortgage payment, condo fees. If it's not a condo, it's a house. I always include maintenance costs because the condo fees are going to cover replacement of stuff outside of your condo. If you own a home, you're going to be responsible for that. So you really want to account for those costs. You may have hot water rentals, utilities, um, property tax, home insurance. Again, if you're in a condo, typically your condo fee covers that. If you're in a freehold home, you're going to have insurance. And then you may have some rental income that we can include as well if you've got a basement suite. And so that can help offset the carrying costs. Ultimately, these are the numbers that should be driving your decision. You want to know what you're going to be spending on a monthly basis because buying a home isn't just about pushing the limits, it's about balance, having enough money to spend um, in your life, be able to travel, and then also be able to save for retirement. So stretching and pushing everything into the home just won't cut it. You got to figure this number out so that you've got enough stuff left over. Um, the biggest mistake that I see people trying to make is trying to time the market. I think at the end of the day, um, it's about your situation. It's about when you're financially prepared. To give a bit of context, like the housing market right now in Toronto, Ontario, Canada, for that matter, is confusing. Prices for most stuff have been dropping over the last year, post-pandemic, and with interest rates having run up. Um, Condos, like every segment of the market is very different. So like condos in Toronto are very different than like a starter home in Toronto. A starter home in Toronto, as crazy it is like, 1.3 to 1.8 million for like a multi-bedroom small home in downtown. Um, those houses are actually seeing multiple offers, whereas condos, there's a ton of inventory. I feel like it's going to be a couple years before that market turns around. So depending on what you're looking for, the market situation is going to be very different. So it's really important to work with a real estate agent that really understands what it is you're looking for. If you're particularly looking for condos in a certain area, work with a real estate agent that knows that, because they're going to have an idea of what direction those property values are going, and when the right time to move on something like that would be. Ultimately, I think the market as a whole is getting to kind of lows. I don't think there's a lot further that things can go down. Condo market maybe a little bit. Um, but I think in terms of value increase, we're probably looking at like pretty stable values for the next couple of years. We won't see the aggressive growth we saw prior to the pandemic and into the pandemic. From an interest rate perspective, I touched on this a little bit earlier, but the Canadian economy as a whole is sluggish to say the least right now. Um, but there's a lot of pressure on prices going up, and so if our economy is doing poorly, slow GDP, lots of unemployment, that pushes rates down or would push rates down. The other side of it is inflation. So the cost of everyday goods going up month over month or year over year. And that is probably the biggest fear for interest rates. Because if that goes up, interest rates go up to try and reduce spending. And the biggest issue or causation of inflation right now is the war in Iran. We did get an announcement this morning that they've come to a 2 week ceasefire, and then oil prices dropped this morning by about 17%. So hopefully that brings some relief. But what happens after that 2 weeks is going to be massively important. So we'll have to see what happens over the next couple of weeks, and then what happens in terms of negotiating that ceasefire further. If that does wrap up, I mean, the oil prices are going to have a trickle out effect and put pressure up on rates. If it doesn't resolve and the war gets dragged out, I'd be very concerned about where fixed rates and interest rates might go over the next 12 months. Common first time buyer mistake. So waiting for the right time. I think only talking to one bank. You need to shop around to find the best terms. And so that's where, like, working with a mortgage broker, we shop the market. We are here to represent you, not the lender. You get an independent third party in your corner to provide advice and make sure you're making the right decisions. Focusing only on an interest rate, is important, but flexibility, service, that trusted relationship matter, and someone that's going to be there for you long term. I think where you can save the most amount of money isn't just on an interest rate you negotiate today, but continuing to optimize your mortgage over the next 25 or 30 years. And so that's where people end up making or losing the most amount of money, is mistakes that they could have avoided early on, that a lack of information or service caused. And then not understanding the full cost. I think I touched on this a little bit in the budget, but like, there's more than just a mortgage payment. You need to understand all the costs that go into owning a home. So let's figure out where you stand. No pressure. I'm here now if you want to ask questions, if you want to connect after. I'm going to send out an email with some of the resources. So I'll send you guys a copy of that spreadsheet that I use, a link to a calculator, a link to book a call with me. So if you want to take your questions offline, and then I'll try and address some of the questions I have now. So if anyone has any questions they want to drop into the chat or the Q&A, I will take a look at what we got there now. So I see one question: what would be considered a first-time home buyer? So if someone's was a homeowner decades ago and re-enters the market, does this reset after a certain amount of time? So this depends. There's a couple different things that are considered first-time buyer. So if you've owned a home before, technically you're not a first-time buyer. That applies differently to different things. So land transfer tax you get a rebate as a first time buyer. Um, it's like 4,000 in Ontario and another 4,000 in Toronto. The definition for land transfer tax rebate is you can't have ever owned a home before anywhere in the world. If you have, you are no longer eligible for that rebate. Using your RSP, if you have owned a home before and have sold that home, haven't lived in that home for 4 years, you are eligible to use the RRSP home buyer plan again. Um, there, uh, the 30-year amortization on insured mortgages for first-time buyers, that is something that's exclusive to someone buying their first home. I believe I have to double check, but I believe that has the same rule as the RSP. So if you haven't lived in a home um, for 4 years that you own, then you become eligible potentially for that one. I just have to double check that one because it is a new rule. I'm not concrete on that. Um, in terms of buying with less than 20% down, that is not something that's exclusive to first time buyers. I could own a home and want to buy a cottage, and I can buy with less than 20% down. So it's very situational on that one. Did Ontario recently temporarily suspend HST sales tax on home purchases over $1 million? They did. They introduced an HST rebate. I think it's up to 1.5 million. Um, Let me take that offline and get you an answer. But yes, they have increased the HST rebate on new build homes. So it's only on new construction, something that hasn't been lived in before that you're buying from a developer. It used to be that the HST rebate went up to a certain point. They have extended that now, and has quite a substantial reduction. It's their attempt to try and bring some life back to the new construction home world because it's come to almost a complete halt in Ontario. I have another one here. When I went for pre-approval, it turned into pre-qualification primarily because I didn't have all the required documents that the bank would ideally like. Um, what should you ensure you provide? So um, the pre-approval is as valuable as the information that goes into it. And so in order to get pre-approved, you need to provide consent, have your credit checked. You need to communicate how much you plan to put down, so how much you're going to be contributing. And then you need to provide clarity around your income. And so for income, depends on your situation. If you are a salaried employee, you'll have to provide a pay stub and a job letter. If you have that salary plus commission or bonus, you'll have to provide 2 years of T4s that substantiate what that commission and bonus is over an extended period of time. If you're hourly and your hours fluctuate, you'll need T4s. If you're self-employed, you need your personal tax returns to show what you're claiming as income in the last 2 years. Um, the important part to note about a pre-approval is it's as, like I said, as accurate as the information that goes into it. So if your income changes from the time that you go for a pre-approval to when you're looking to buy, the moment your income changes, your pre-approval changes because when you go from pre-approval to actually purchasing, the lender is going to review all of your documents again. So if you've lost your job, or if you've got a raise, or if you have 20,000 down instead of 30,000, all of that should instantly impact your pre-approval. For me, a pre-approval is like an ongoing process where with my clients, we have an open channel of communication. Hey, I just got a $5,000 raise at work. Let's update your numbers. Hey, I had a family member that needed 5 grand for medical expense. I send it to them. So I've got 5,000 less to put down. Let's adjust your pre-approval so you're working with accurate numbers. So I think hopefully that answers that one. Um, And then I've got one more here. How can you shop around for best rates with various mortgage lenders without hitting your credit over and over with credit reports so you can see who has the best offer? You have two options there. You can do that yourself by going bank to bank and having each lender check your credit score, or you can work with a mortgage broker and we do a single credit check and we're able to shop your mortgage around to every lender we work with. I have access to about 40 different lenders, banks, credit unions, mortgage companies, and based on your situation can advise on what different rates and offers are available from each of those lenders with one credit check. You also get the added advantage of with a mortgage broker, you get our volume of business, meaning you're taking a mortgage every 3 to 5 years to negotiate with a bank, and that mortgage might be 500,000. I personally do about $35 million of mortgages every single year and have these relationships with lenders. And so they're trying to advertise to me to get me to send clients to them because they know every year I'm going to be doing this volume of mortgages. And so they're offering their best rates to me as an incentivization to try and offer those to my clients. So I don't have to negotiate for best rates. I know what lenders are offering every day. And then can you pull your own Equifax or TransUnion report to provide? No, unfortunately, like the credit reports that we use in the mortgage industry come directly from Equifax or TransUnion. They're a mortgage specific score, so the score that you see on your TransUnion app or your bank app is a consumer score, and that's usually what's used for getting a credit card or something else. Whereas mortgage lenders have a unique credit score that Equifax and TransUnion have built for mortgage lending that weights different criteria differently. The only way to access that is if you have a license with Equifax or TransUnion to pull that credit report, and you have to be a mortgage lender or broker. Um, Hopefully that was helpful. Is there any other questions? Oh, I see one more here. What happens in a situation where you put a deposit down on a house, but then you lose your job between then and closing date? I've actually come up against this a couple of times. So it really depends on the lender that you're using. Um, Most of the lenders that we work with, and it varies, but most of them will do an income verification at the time of approval. So they review your income, they call your employer, and then they sign off on your income, meaning the income has been approved. And so if something changes between that point and closing, then it doesn't impact the mortgage. In the cases that I saw, I had a client lose his job 3 days before closing. There was no issue. I had another one that was about 3 weeks before closing quite recently, actually. And again, the lender had already done the income verification, had already signed off. And so there was no further review done. There are some lenders that do those verifications much closer to closing. And so that can certainly be an issue depending on the lender you're using. Uh, So I got one here. How do you charge for your services? Is it a percentage? So as mortgage brokers, we are compensated by the lender we end up placing your mortgage with. So if I take your mortgage to BMO or TD or Scotia, they pay me a referral fee for bringing you to them as a client. It's kind of like a marketing budget for them. It's a way for them to source new clients. And so there's no fee charged to the borrower at all in that situation. There is another world of lending that's called B lending um, for credit or self-employed that maybe aren't claiming all of their income on their tax returns, and we need to go to more unique lending. In those cases, lenders don't pay us and we do charge a fee. But I would be very upfront about us going down that path before we even do and disclose all those fees. Typically, it's 2% of the mortgage amount, and typically you're looking at interest rates 0.5% or 1% higher than traditional lending for that. But in most cases, there's no fee to work with the broker. We're paid by the lender. What are the risks with purchasing new builds as a first-time home buyer? I hear you need upwards of 10% deposit to cover building costs. So even with HST incentive rebate, it's a lot to put down rather than just 5%. Yeah. The risks are like what we've seen, I think, for a lot of people over the last couple of years is you buy at a certain market price and then the values shift. So, you could buy something at 900,000 and when you go to close, it might be worth less. And most of the builders have a relationship with a bank that are doing what's called a blanket appraisal. And so that it's not necessarily an issue to close, but it is an issue to own that. So I would say that's one of the biggest risks. And in terms of the deposit structure, every builder is different, every project is different. So some builders have like 5% down on signing the contract, and then 5% like 180 days later, and then a year later, and then 2 years later. Some builders have like very small deposits up front and then $1,000 a month. So each project that you look at is going to have a very unique deposit structure. So if you're planning to buy with less than 20% down or access to cash is an issue and you do want to buy, might be better to look at resale or a project where the deposit structure is maybe lower or lower amount required to purchase. A few more questions coming in here. Please continue. As long as you guys have questions, I'm happy to keep answering. So um, please send them in. Um, if there's any other questions, there's a Q&A tab at the bottom. You should see where you can drop the questions. Those are coming in. You can also, raise a hand and let me know that you have a question or drop it just in the group chat or as a direct message to me. I'm looking there. I don't see any other questions, but I'll give you guys a minute. If there is anything, let me know. Otherwise, we'll wrap it up there. I will send out a recording of this as well. So if you want to rewatch it, or you have a partner that wasn't able to join that you want to share it with, or friends, family, you'll have the link and the password to access the recording as well. Did everyone find this helpful? Was it good? I get some thumbs up. Awesome. One more. I could see a question here about self-employed. Um, if self-employed income typically viewed as the full amount. So self-employed gets a bit complicated. There's three levels of lending. So depending on if you're sole proprietor, incorporated, um, it can be structured differently. The standard rule is they're going to look at your last 2 years of personal tax returns. And so that currently, depending on where you're at, but might be 2025 and 2024 tax returns. In there, if you are sole proprietor, you are reporting your income with a gross and a net. The net income is your income after expenses that you end up paying tax on. The lender is going to look at your net income from 2024 and 2025 and then add them together and then divide by two. and that's the income they'd be able to use. If you're incorporated, you might be claiming dividends, or you may be T4ing yourself. You need to take a 2-year average of that. If you've got retained earnings in your corporation, there's some lenders that will look at that as well. And then with the B lender route that I mentioned earlier, much more flexible. We can actually just look at 12 months of business bank statements and see what's actually flowing in terms of cash through your business, and then what your real expenses are, and use that income to qualify. So it can be much more forgiving. Hope that answered, but the self-employed is obviously much more of a beast in terms of understanding it, and happy to do a call or take it offline and provide more insight on that. Awesome. I think that addresses all the questions, unless anyone's got anything else. Really appreciate you guys being here, and I hope it was helpful. Don't hesitate to reach out if you do have questions. Cheers, guys.